Hello dear viewers, hope you all are doing well. Welcome to our video on Basic Concepts of Accounting Part 2. Today in this video, we will be studying about revenue recognition concept, matching concept, full disclosure concept, consistency concept, conservatism concept, materiality concept, and lastly, objectivity concept. Before we study about these concepts, let us quickly revise what we have studied in our previous video, that is Basic Accounting Concepts Part 1. Let us get started. We studied about generally accepted accounting principles, that is GAAP. With this, we understood about accounting principles are the rules, principles or concepts which are laid down and which must be followed by all the business entities while recording and presenting the financial information to various users of accounting information. This makes the users of users of financial information to compare, study, rely on that information and understand the information in the same sense as it is intended to be presented. The accounting system, these accounting principles were adopted to bring uniformity and consistency in the accounting process. And with generally accepted, it means that it is globally adopted by all the accountants in recording their transactions and presenting their financial statements. Next, we studied about separate entity concept. In this concept, we understood that owner and the business have separate legal existence. They are not same. Owner cannot record his personal transactions in the books of account, and whatever amount he is contributing towards business is capital, and his business is liable towards that amount to the owner. And if the owner is taking out money from the business, it is termed as drawings, and it is the reductions in liabilities of the business. Next, we studied about money measurement concept. In this concept, we understood that whatever information we are recording in our books of account must be expressed in terms of money, must have money value, must be quantified, like sale, purchase, rent, salary, whatever transaction which can be expressed in money, which has monetary value, can be recorded in the books of account. Here there was a limitation that qualitative characteristics cannot be recorded in the books of account, like qualitative characteristics like hiring of new employees, appointment of new manager. Though these information are affecting the course of business, the activities of the company, but still they cannot be quantified. They are qualitative information, they cannot be recorded in the books of account. Next, we have going concern concept. This concept states that business will continue its operations for a long period of time, and whatever accounting information is presented in the financial systems is prepared and presented with the motive that the business will continue its operations for fairly long period of time. Next, we have accounting period concept. Accounting period concept states the time span or time frame between which all the business activities are being undertaken, and at the end of which all the financial statements must be represented to the users of accounting. So this time span is of 1 year, which is usually from 1st Jan to 31st December. Whatever activities business activities have been occurred in this 12-month period are all presented in the financial statements. Next, we have cost concept. In this concept, we studied that when we are purchasing an asset, whatever costs are incurred until that asset is ready to use, all such costs are to be recorded in the books of account, like cost of acquisition, installation cost, transportation cost. Whatever cost a business is incurring to make an asset ready to use, all such costs have to be recorded in the books of account. Here we saw that this concept is historic in nature. It records the purchase price of the asset as and when it is purchased. It does not take inflation into consideration. Next, duality concept. In this concept, we studied that every transaction has twofold effect. Every transaction has two sides, dual sides, like debit and credit, and it must be recorded two times. So, this is about duality concept. Remaining concepts, let's study now. So, first concept for the day is revenue recognition concept. Before we understand about this concept, let us understand what is revenue and what we are recognizing. Here, revenue means inflow of cash. Cash inflow by the activities, by the business activities, maybe by sale of goods or services rendered. Whatever cash is coming into the business is revenue for the business. Recognition is point of time. Point of time the good was sold or the service was rendered. So under revenue recognition concept requires that the revenue for business transaction should be included in the accounting records, which means that revenue must be included in the accounting records when it is realized. Means when at the point when the goods are sold or the service is rendered. Revenue must be recorded in the books of account at the point when the goods are sold or revenue is been rendered, irrespective of the cash is received or not. Right? Revenue is assumed to be realized when the legal right to it receives, the point of time when goods have been sold or service has been rendered. Here we are not considering to record that transaction when we receive the cash for it, but we record that transaction at the point of point of sale or point of service. This is about revenue recognition concept. Next one we have is matching concept. This concept states that expenses incurred during a period is matched with the revenue earned during that period, and this is done to ascertain profit or loss for the accounting period. Got it? The process of ascertaining the amount of profit earned or loss incurred during a particular period involves deduction of related expenses for the revenue earned. Whatever expense we are incurring to earn a particular revenue, that have to be deducted from the revenue. That is known as matching concept. It states that the expense incurred in an accounting period should be matched with the revenue in that period. This principle states that the necessary to charge all expenses incurred to earn revenue during an accounting period against the revenue in order to ascertain the net income or trading results of the business. Here it's only that we are matching whatever expenses we are incurring to the revenue earned to ascertain the profit or loss for the particular financial year. See, revenue with associated expenses is calculation of net income. This is matching concept. Next one we have is full disclosure concept. This concept in simple terms means that business or a company must disclose all the information relating to the business in their financial system. All the financial statements must present the true and fair value about the business. Full disclosure principle refers the concept suggests that business should report all necessary information in their financial statements so that users of accounting information are able to read the financial information and are better positioned to take important decisions. We know that there are various users of accounting information and each user use the accounting information as per their need. So it's the business is responsible to report each and every necessary information in their financial statements, like loss made during the period, machineries and assets with the business during a particular period of time. Whatever necessary information which is related to the business must be presented in the financial statements, like non-monetary transactions, motive of particular decision taken, whatever merger, acquisition and disinvestment had taken place, contingent assets and liabilities, related party disclosures, auditors, whatever accounting standards they are following, what change in the accounting procedure they have undertaken, materiality. These all information must be presented in the financial statements. Next one is consistency concept. This concept in simple terms means that business must follow the same accounting methods and procedures for every year to present and prepare their financial statements, because it becomes easy for various users of accounting information to come to conclusions or to compare their information from one year to another year or from one firm to another firm. So, consistency principle states that business should maintain the same accounting method or principle throughout the accounting periods, so that users of accounting information are able to make the meaningful conclusions from the data. Consistency in accounting principle helps in performing comparative study of the financial performance of business. So, consistency concept states that whatever methods, policies, rules, guidelines a business is following in maintaining their books of account, recording transactions, preparing financial statements must be same for all accounting periods. Next one we have is conservatism concept. This concept is also known as prudence concept. This concept states that business must record anticipated or expected losses in the books of account and must record profits or gains only when they are actually earned. This is known as conservatism concept. The approach of providing for the losses but not realizing the gains until these are realized is called conservatism concept. This approach is adopted to give the investors an idea and clear picture about inflated revenues and assets, and also about the understated liabilities. It states about the understated liabilities. Next one we have is materiality concept. This concept refers that the material item should be reported properly in the financial statements. Whatever items, material items which will affect the decision making process, all such items must be presented in the financial statements. Material items are considered those items inclusive or exclusive results in significant changes in decision making for the users of business information. Here, let us understand with an example. Let us assume that a person has to pay 100 crores to a company. Now, while he has defaulted rupees 100, it does not affect to the business. Rupees 100 will not make any sense. So, it is immaterial. Now, if while paying of 100 crores, he has defaulted of rupees 30 crores, this is material. This is affecting the business. Whatever items, materials that can affect the business and which can affect the decision making process of various investors must be recorded in the books, in the financial statements. All items that are reasonably likely to impact investors' decision making must be recorded or reported in detail in business financial statements using GAAP standards. This is about materiality concept. Next one we have is objectivity concept. This concept states that accounting transaction should be recorded in objective manner, free from bias of accountants and others. Here, this concept states that the accounting information which is presented must be true and fair, must be free from errors and frauds and mispresentation or biasness, right? Because this information is used by various users like stakeholders, investors, potential investors, creditors, government, various users of accounting information. This concept states that the information, financial, whatever accounting information is presented must be transparent and must be based upon solid evidence, not just based upon some opinion. There must be evidence for those transactions. It must be correct, fair and true. The objectivity concept is referred as principle, which states that financial statement should be objective in nature. In other words, that the information should be unbiased and free from any kind of external and internal influence. It only means that the objective of presenting the accounting information must be free from errors, fraud, misrepresentation, and correct information must be provided to the various users of accounting information. With this, we come to end of today's video. We have studied various accounting concepts, and if you're feeling difficulty in any of the concept, please post them into the comments. Until then, watch, like and subscribe to our channel. Happy learning.